Hello everybody. So in this video I want to cover ARK Invest. It's a little different video today, covering one of the most famous ETFs when it comes to growth. And so let me just start by saying that I've been historically in my videos very positive about ARK Invest. I like their style, so I come with this bias already. I like their style, but I do find that their style is more out on the risk curve. They are more out on the risk curve than I am. I think the way Cathie Wood invests is riskier than my style. Because I usually buy stocks that are growing at 30% revenue growth right now, within the next 12 months. And if they don't, then I don't add to the stocks and I consider selling. That's not how she does it. What she does is she aims 15% annual return per year for 5 years at least. And that return is defined in the stock price. So she looks at the stock price and she looks for stock price appreciation. So that means that she's going to get into, say, value play, where she's going to be playing on an expansion of the price to sales ratio, for example, which is not the type of investing that I do. I'm almost a single issue investor, that I care about adoption and I care about revenue growth. That's my style. She likes to look at stock price growth and 15% over 5 years, which, I don't find that ambitious given the type of inflation that we are seeing in the US dollar and that we're about to see when the Fed pivots next year. So it's a different style, and I would also summarize her style as she has no problem buying a stock expecting a sudden surge in revenue growth. And the best example of that is her investment in Tesla. If you look as to why she owns Tesla, she will tell you that the main reason why she owns Tesla is because FSD is going to get solved. That's a binary event. And then FSD is going to be released in robotaxis. That's a binary event too, right? And I own Tesla as my number one position. Why do I own Tesla? Because I see long-term EV adoption and I see their sales going up quarter after quarter and after quarter. The sales consistently go up. When you read her thesis about Tesla, she barely talks about it. All she talks about is when FSD is solved, the stock will see a step change in its valuation, right? That's a different style of investing. I'm more of a steady Eddie, but fast type of growth, type of investor. And I just want to say, there's a lot of pros to her ETFs. And I think the big pro is, of course, that she trades in and out of stocks. She can move away from bad stocks into new stocks, and she can manage it for you, right, without you having to pay any taxes. And so it gets very compelling when you can just own an ETF that represents all of innovation, and you don't have to swap between stocks. You just own one stock in your brokerage. But of course, she does all of the swapping, but that's not taxable, right? That swapping is not taxable. At your own level, it looks like you've owned the same asset. And I think that has a lot of advantage if you want to have more of a in and out of stocks, more of a trading strategy, more of a focusing on active management strategy without having to pay taxes every time you sell a stock. So that's the big pro. The con of that, of course, is the annual fee at 0.88. If you have read any of the Jack Bogle books, let me summarize them to you in just one sentence, is the fees kill the returns. That's essentially his books. Buy the index and pay low fees. And of course, 0.88 is actually a little high, but it's nowhere nearly as high as to where it used to be. If you watch this show and you're in your 40s, you may think that 0.88% is actually not that high. But today it's considered pretty high compared to other assets you would buy. For example, the triple Q is a 0.2, so that's more than four. That's about 4.5 times more expensive than the triple Q, which is the other main innovation-driven index. Totally different type of indexing and index investing, though. So, and today's analysis, just as a quick aside, I will be focusing on ARKW today. Why am I focusing on ARKW? Because the few times I've brought up ARK on this channel and, in other places, I often talk about ARKW and not ARKK. That's due to my bias for Bitcoin, but that's also due to my bias for total returns and great total returns, and that's likely due to Bitcoin, that overperformance. But there's kind of a joke that goes, if you add a dash of BTC, that can do wonder to any portfolio. Just add 1% of BTC and look at any portfolio, and you see the returns exceed other portfolios who had BTC. No financial advice, of course, but I have my own bias, and I like BTC. Bitcoin is my second asset behind Tesla. So anyways, if you compare ARKW to ARKK, as you can see in blue right there for ARKW, what do you see? Well, over a 9-year period, it has significantly outperformed ARKK. ARKK is only at 10.65%. Average annual total return is only 10.6% a year. ARKW has been 16.5%. So ARKW actually perfectly aligns with the NASDAQ as far as total returns right now. Granted, it's been much more of a roller coaster to own ARK ETFs than it has to own the NASDAQ, although the NASDAQ did see a 30% drawdown too. But it's worth noting that ARKW so far has had a similar, has had a performance very similar to the NASDAQ over the past 9 years. So what I will do now is I will give you a brief commentary on all 10 stocks that are in the ETF in order of importance for that ETF. So I am starting with Coinbase. Coinbase is the number one stock in ARK Invest's ARKW ETF, right? Next generation internet ETF. Coinbase is the number one. So what do I think of Coinbase? I actually own Coinbase. It's one of my few stocks that does not have steady growth that I own. Coinbase, what are they? They are the uncontested regulated crypto exchange. They are the leader in the USA. They are the only exchange who takes on the SEC in a lawsuit. And if you're into crypto, you may know that a lot of people say DEXs are much better. Uniswap, things like that, they're the way to go. And that may be true once you fully transition to a crypto world. But for somebody, which is most people, who operate in a hybrid world where you operate both in the fiat world, right? You have dollars, and in the crypto world, you need an on-ramp. And on-ramp is always going to be what we call a CEX, a centralized exchange. That's the on-ramp to the crypto world from the fiat world. And Coin is the king of CEXs. It's the number one centralized exchange. I mean, the second ones don't even come close in the United States, at least. Coinbase is also an ETF on all things crypto. They have a hand in every single crypto project out there. They have Coinbase Ventures. They've invested in just about everything. They're the partner of choice for institutional buyers. So imagine those ETFs, MicroStrategy, whenever an institution, countries down the line, whenever they want to buy Bitcoin, they're likely going to go to Coinbase. And they're the custodian for Bitcoin for many traditional financial institutions, MicroStrategy, Fidelity, etc. They are the leading custodian. They're also a leader in staking. If there is staking, you bet they have some money staked and some of their funds from their trading platform staked. And so if you look at their annual income statement, they have a huge line for staking rewards and staking revenue, and they make a literal fortune on USDC. So if you know USDC, Coinbase owns 50% of the USDC project. USDC is a stable coin, right? It's the dollar trading on crypto rails. Now, here's the trick. If you have, and I think the numbers are about 80 billion. Last time I looked, it was about 80 billion. If you have $80 billion of USDC issued, you're going to be earning interest, right, on those $80 billion, because they are going to be held in short-term treasuries. So you're going to be earning interest on this coin, right, this USDC coin that is trading on crypto rails, which does not earn interest rates. And so they make a lot of money just being at the root, at the base of the financial infrastructure of the future. They make a bunch of money doing that. And so I believe Coinbase will greatly benefit in 2024 because the bull run is coming. We know we have the halving, and altcoins will follow, and Coinbase is an exchange. It benefits whenever there is trading. And sure enough, if we get into a bull run in 2024, which I believe we will, then Coinbase will benefit. And this is likely to remain a cyclical stock for a very long time, where you're going to have great years where they make outsized return, and then you're going to have what we call crypto winters, where they make way less return. So this stock definitely more of a roller coaster. Let me move on to the second stock that Cathie Wood owns. 10% of her ETF is in Roku. So what is Roku? Roku is software for your TV. And to understand Roku, you kind of have to agree with this premise, which is Samsung, Sony, LG can't do software right. And I can tell you, for being the sad owner of LG TV, that I should have gone with a Roku TV, because I'm stuck using a Roku stick, because the software on LG, I don't know about the other software, but it's just not there. It is just not there. It is not as responsive. Now, if you only watch Netflix, maybe you don't care, because it's just a matter of clicking a button and you get on Netflix. But most people don't, right? Most people do many things on their TVs. As soon as you're more of a power user of your TV, you're going to likely be upset with the software that comes with these makers of screens, right? Samsung, Sony, LG, they're maker of screens. And here's the main question behind Roku is we live in a world today where all TV screens, quite frankly, are outstanding. I mean, quite frankly, it's like, yeah, I mean, today buying a TV, it's all about the software. I mean, there used to be a time where you had a TV who had much deeper blacks than over black, like the darkness, the black, the crispness. All of this today. I mean, today we don't have the issue of, let's say, the quality of the blacks or the quality of the colors on the TV. We don't have any issues like this on a TV anymore. All TVs are great, and so if all TVs are great, if image quality is always great, isn't software all that matters? And that's kind of the point. It's like if you would buy Roku, you would have to look at whether does software always matter. And if so, then Roku is the standalone software that competes against Google Android TV and Apple TV. They are that standalone software. That's what Roku is. So it's a powerful, very powerful software. And as far as Roku's presence in the USA, it's everywhere. If you go to Walmart, most TVs are Roku TV. You go to Costco, most TVs are Roku TV. They are everywhere in the US, right? That's what we see most TVs sold with software here. And actually, they have the number one operating system for TVs in the USA. And if you read their annual report, they actually just became recently the number one TV OS in Mexico as well. So they are starting their international expansion. Now, that's 76 million active TVs. Keyword here is active. 76 million active TVs. And so it's a stock that's kind of a slow growth stock for my taste. But that's probably because the advertising is still suffering because of the economy, right? The real world is going through a bit of a recession right now, and so there's less advertising. But if you look at the business, it's doing well. New accounts, active account growth is 16% year over year. Revenue growth is 20% year over year in this bad advertising environment. And the bet, I believe, if you buy Roku, is that you think that advertising will come back in full swing, full strength, and lead this stock to go way more. By the way, I did a full dive on Roku. I also did a full dive on Coinbase, and I'll put these links in the description if you want to get those full dives for these stocks. Let me move on to Bitcoin. So she owns GBTC, of course, because if you want to use traditional finance rails, you can't own Bitcoin on traditional finance rails. You have to own a fund who owns the digital asset, and the main fund who owns the digital asset, of course, is Grayscale Bitcoin Trust, ticker symbol GBTC. GBTC is form of a Bitcoin, sort of a Bitcoin on steroids. Used to be much more of a Bitcoin on steroid than it is now. The reason why I say that is because once the spot ETF is approved, and it may be January, many people are claiming 99% chance it happens before the halving, so it may be January or February. When it happens, you have a built-in 11% gain. That's why I'd say it's Bitcoin on steroid, because of course there is a discount to net asset value in the fund, minus 10%. Keep in mind, this stock traded at some point at nearly 50% discount to the value of BTC. So you still have that built-in event where the GBTC is gonna go up 11% right now, and you can see the discount has been decreasing as the odds of an ETF getting approved are getting larger and larger. And of course, you own Bitcoin too. So you own the underlying asset too, which is what? What is the underlying asset? Well, it's quite simple. It's the Bitcoin halving in April. So the supply of new Bitcoin issued, which by the way, most Bitcoins sold on exchanges are Bitcoins that are issued by miners, that are issued to miners, sorry, not by miners, that are issued to miners by the algorithm, and that are sold on exchanges so that miners can pay their energy bills. This is how it works, right? And so the supply of new Bitcoin gets cut in half in April. So that's going to be a theoretical 2x. If the demand remains the same and you cut it in half and you cut the supply of new Bitcoin in half, theoretically you get a 2x. And then we may get a lot of more money getting into the space because the Bitcoin approval will lead, in my view, to institutional money flowing in. And the question is, when you look at how many trillions of dollars under management many of these asset managers have, I believe BlackRock is something like $12 trillion. You start asking yourself, well, what happens if a 1% allocation or even less than a 1% allocation happens or is recommended by financial advisors around the world? How many times does it multiply the market cap of Bitcoin? And the answer to that is probably by quite a bit, because unlike gold, gold or oil and gas, price of gold goes up. What happens is that you have more people who start to mine gold and they start selling gold. There's no, you can't, if you have more miners mining Bitcoin, the issuance of Bitcoin will remain the same. The only thing that will go up is the difficulty of the mining algorithm, but the supply issued remains the same regardless of the price. This is one of the main difference of Bitcoin versus commodity money such as gold, which is why it's not like, if the price of gold 5x's, you bet there's going to be the miners who are getting as much gold as they can out of the ground. And the stock price goes back down. Problem with commodities. You can't do that with Bitcoin. It's not possible to do that with Bitcoin. You can't get more Bitcoin out than the pre-scheduled issuance of Bitcoin. You can still get a little bit of selling, but that's not going to be the bulk of it. The bulk is you can't create more of it. So that's why it's a valuable asset. It's digital gold. Moving on to Block. Her fourth position, by the way, Bitcoin was 8.5%, her fourth position. And if you add the discount to GBTC, by the way, that's closer to 10% Bitcoin if you add that discount back to that 8.5% of the fund. Square, what about Square? So Square is a company that I used to own. I sold it for better opportunities. Future will tell whether it was a good thing or not. The reason why I sold Square is because the revenue growth has stalled, and right now it's predicted to grow the next 12 months at 12%. But fundamentally, when you look at Square, there's a lot of good things happening with Square. It's the quote-unquote triple play, as I like to call it. There's 3 disruptive assets going on with Square. The first one is the small business payment terminals. Those payment terminals that you plug into your iPhone or to your payment system at the local small business bakery, whatever, coffee shop, whatever. Mature business, cash flowing, great for them, will continue growing at the pace of the economy or a little faster. What's great though about Square is Afterpay and the Cash App. Afterpay is one of the leading players in the buy now, pay later movement. What is buy now, pay later? Well, buy now, pay later is the disruption of credit cards, quite simply. Gen Z, younger millennials, they can't stand credit cards. They don't like them. And because they don't like them, they live in a world where they may never get one. And they live in a world where they actually may do, pay over time, right? Pay over time with Affirm, pay over time with Afterpay, pay over time with Klarna, pay over time with PayPal paying for, Shopify paying for. And I have no issue imagining the youth, right, having an Afterpay account and an Affirm account and a PayPal account, and that's their free BNPL payments systems that they use. Just like today, I have no issue seeing a customer having a Visa, a MasterCard, and an American Express. But if BNPL is going to be a thing, you bet Block is going to benefit, because Afterpay is, of course, one of the leaders in the field. I think that's very compelling in the long run when you start thinking about this. And then the second one is the Cash App. The Cash App simply killed Venmo. Venmo is not a thing anymore. It's not as strong. It's not nearly as strong as it used to be. And the Cash App is the leading digital wallet in the USA. It's the number one. Everybody has it, quite frankly. It's targeting younger folks, and younger folks are more involved with the app in the sense that they have their payment card. There's a pink payment card that's very popular right now. So if you go to, quote, trendy areas, you'll see people with that card and people drive that card. It's very Gen Z oriented, right? Sometimes even their market. Their market is they want to be the first financial institution of the generation of tomorrow. They do other things like direct deposit. You don't have to do your direct deposit to a bank. You can do your direct deposit to a payments app, and that's what these quote unquote kids do. They much prefer it. They understand the app. Right? Banks don't speak to the new generation. Apps do. And they have the leading app for other things, like for other age groups, paying contractors. If you have a landscaper or whatever, they're likely going to want to be paid with a Cash App. It's very popular to pay anybody. And of course, the platform lets you buy stocks and BTC without having to go for a bank. You do everything in the wallet, everything in the digital payments wallet. And, that's a very compelling proposition in my view. Only downside for me for that stock, it's a little pricey, number one, and the revenue growth is too low. But we'll see. We'll see what happens. But if you own that ETF, you own Square. Moving on to Zoom. Whenever I hear Zoom, all I think about is dirt cheap. That's what I hear. I hear, it's a dirt cheap stock, and we'll see in a second why it's so dirt cheap. You may know what Zoom is. Zoom is the story of Zoom against Microsoft Teams, just like Slack is the story of Slack against Microsoft Teams. It's all about specialized software that's for more pro users versus Microsoft in the enterprise space. That's pretty much the discussion. It's like you're going to be competing against Microsoft. If you are a software and Microsoft is kind of going to copy you, and of course a lot of the features of Zoom Microsoft has copied, but Microsoft did the same thing to Slack. But to own Zoom, I believe you have to believe that Microsoft is the follower in the space, and that the innovator is Zoom, just like Slack is the innovator in modern company messaging systems. And the main bearish case for Zoom is, will everyone move to Microsoft Teams? My answer to that is, I don't think so. I really don't think so. There will always be pro users. There will always be users that care much more about the ease of use of the software. And if you know anything about Zoom, Zoom got started by 40 engineers who quit Cisco in the early 2010s because they were tired at the bulkiness and cumbersomeness, I don't know if that's the word, but at how cumbersome Cisco WebEx was. And Zoom essentially killed Cisco WebEx. If you still use Cisco WebEx, I'm sorry to let you know that it's not really a big thing anymore. And it's funny that the main players in town now are Zoom and Microsoft Teams. Kudos to Microsoft Teams for not hesitating to kill their own Skype too. I think it's important to acknowledge Microsoft here, but there will always be a need for pro users. There will always be people who don't want to be too dependent on Microsoft. The Microsoft dependence can be a major problem. You can't really negotiate with Microsoft. You may be able to negotiate with Zoom. So that's why a lot of people choose Zoom. Stock is dirt cheap. How dirt cheap, you ask? EV, enterprise value over sales of 3.1. Gross margin is excellent at 75%. It's a profitable company. Price to earnings ratio of 13. Would I rather them have no PE ratio and invest in their growth? Absolutely. That's not the way they've chosen to go. They've chosen to harvest the business. They've chosen to make money. And that's probably why they have such a low valuation. If I were them, I would invest much more heavily in my growth. I would invest much more heavily in my marketing. I would invest in, ways to compress the video. And maybe they already do that. Maybe they've run out of ideas of things to invest in and ways to grow. Maybe their marketing has run out of his ideas. Anyway, the point is 4% predicted revenue growth. That's the rate of the economy. So this is a stock that in order for it to go back up, we need to go back to the long-term thesis, which is hybrid and remote work. And I believe that is still the way of the future. Hybrid and remote work is still going to be the way of the future, in my view. But right now, we are in this period of rebound from the events of 2020. We're in a period almost of rejection of what happened in 2020. And you still have companies forcing their employees to return to the office, forcing people to return to the office. But in my view, you can't fight the future. You can't fight the future. Your best employees who have tasted remote work and happen to love remote work, your best employees, it's gonna be either remote work or they're gonna quit and work for another company who gives them remote work. So anyways, and even if you agree that return to service is the thing, hybrid is here to stay. But the stock could still nonetheless be, not to sound like CNBC here, but quote unquote dead money for a few years. I mean, the stock could go sideways for a few years as long as so many companies are pushing this return to office trend. That's at least the view that I have, and that's why I try to stay a little bit away from this stock. But from a value standpoint, I wouldn't blame anybody from buying it from a value perspective because it is a cheap stock. It is a pretty cheap stock. Anyways, moving on to UiPath. I covered UiPath yesterday. So let me be really quick about UiPath. They're the leader in robotic process automation. What is robotic process automation? It's things like copy pasting on the computer, getting a file, renaming a file, moving it in a different folder, copying and pasting text, you name it. Any sort of thing that you can do with your cursor on the computer. I'm moving it right now. Like modifying, moving things. You can teach robotic process automation to do it for you. So it essentially automates low skill, low value add, repetitive computer work, which is what so many department assistants of all kinds in all sorts of departments do all day long. These kind of complicated jobs, at least mind-numbing or repetitive type of jobs. That's what robotic process automation is going after. They've been doing very well. They've averaged at 35% CAGR, but there has been an inflection in their growth, knowing that from Q3 to Q2, they grew 15%, and their guidance tells us that they're going to have almost 18% growth for the next quarter. So quarter over quarter, 18% growth. If you annualize that, you get almost an annualized rate of growth of 90%. And there's no guarantee that they're going to be able to annualize that or keep that up. But they could also increase, right? Like they could also guide for another 20% Q over Q in Q1. So we really don't know. Point is, the stock is cheap. The stock is very, very cheap. If you go into my valuation spreadsheet and you put these assumptions for revenue growth, i.e., more than 30%, more than 50%, and more than 80% in the optimistic case, I get a cheap stock. So I like UiPath. I find this stock cheap, and of course, cheap is secondary to the growth. What I like the most is the growth. And to think that this is a stock that could grow more than 50% over the next 12 months is very, very exciting. And it compels me to buy stocks that do this. So I like this very much, and I am a shareholder of UiPath. Moving on to Roblox. So Roblox, another darling of the 2020 and 2021 years. So is Roblox a key social media of the future? This is kind of a big question that you have to ask if you consider investing in Roblox. That's why Roblox is often framed as competing against Meta's metaverse, right? Formerly known as Facebook. At the risk of stating the obvious, those people who are 13 today will be 20 in 2030, right? And people who are 11 today will be 18 in 2030. And when you invest for the future, and you invest for the next generation. And the question is, because this is the most popular app among teenagers and younger. So the question is, will this generation stick to Roblox? Will Roblox follow this generation through adolescence, and will Roblox then follow them in the adult age? It very well could. It very well could, and that's kind of a bet you're making. Also, what happens when Apple Vision gets released? When the next generation of Oculus, they keep releasing them, when they keep releasing versions that are even better and better of AR, AI, and VR glasses, right? What happens when this happens? Does Roblox become even more compelling, where you can just wear a pair of glasses, right, like Apple Vision, and just be immersed in this digital space? And there's a lot of there's the future of play, but not just play. There's probably a lot of future of work, future of social media. At least that's where a lot of technologists today think the future is headed. That's why it's often deemed to be the metaverse play. And actually, if you look at Roblox, this is one thing that always surprises me, is the scale that this platform can get with concerts, right? You can have a 600,000 people concert on Roblox. You can't do that in real life. And so even if you charge, I don't know, $10, $20 to attend your concert, of course you don't charge bucks, right? You charge Robux, the currency of the platform. You may get to see a concert from a star in a digital space. And I'm showing this to you to show you the quality of the pictures, the quality of the avatars. The quality of the avatars is getting better and better. Keep in mind, this is not Mark Zuckerberg interview with the latest tech. This is the currently released tech, and you can see this is going to get better and better. And with the speed of AI, with the speed of computing, we have to imagine that 5 years from now, this picture will be not indistinguishable from a real human. And I think that's where we are headed. In fact, you may be surprised to see Roblox look this good, because a few years back, Roblox was literally square people. So it's not like that anymore. It's getting better and better and better. Now, would I buy Roblox? No, because to me it's too binary. It's too binary. It's like, is metaverse gonna be a thing? Yes or no? And if it's a no, you really don't have that many backups. So it's too binary of a bet. That's why I say Cathie Wood is more out of a risk curve than I am. And because it's so binary, of course, their revenue growth, I guess at 13% is at the speed of the digital economy, maybe a little faster than the real economy, but barely. And also, what's wrong with that gross margin? That gross margin is pretty low. I'm not used to seeing gross margin this low with software type business, social media type business. So I do not like the gross margin, and the price, given that gross margin and given that low growth at a 9x, that price is no good. So I don't even need to use my spreadsheet to tell you that this is probably a very, very overvalued stock based on my usual spreadsheet that I use to value stocks. And moving on to Draftkings. So when it comes to Draftkings, so as far as Draftkings go, it's a bet on the deregulation of online betting. So it's a bet on the deregulation of online betting. And I live in Texas, so it's not allowed in Texas, and I think there's quite a few states where you still don't see that. But whenever I go out of state, I do see Draftkings everywhere, and it's heavily advertised on highways and freeways, and I have to believe that a lot of people use Draftkings quite often, right? And Draftkings to me also have this binary risk. That's the binary risk that a lot of the Cathie Wood picks used to love. That's why it actually makes sense to own this as an ETF. But what is the binary risk to Draftkings, in my view, is if you follow this space, you may know that online betting is a thing, mostly because they are positioning themselves as a game of skill and not as a game of luck. And so if you position yourself with, and they're big on football betting and fantasy football, all that sort of stuff, if you position yourself as a game of skill, you are legally allowed to operate. If you position yourself as a game of luck, there's more regulation and you're generally not allowed. And so I think this is a binary risk, because a lot of regulators have pointed out issues with platforms like binary risk. Nonetheless, it's worth mentioning that it's growing very fast. At next 12-month growth, 53% expected next 12 months growth. So it's growing very, very fast. gross margin is also absolutely. I mean, it's okay. I mean, I would expect it to be a little better for betting, but it's decent gross margin at 37%, right? If it was a brick and mortar business, 37% would be good, but 37%, I guess it's okay. It's okay. And the enterprise value over sales is a 5.9, which is also okay. So it's not the cheapest stock. Gross margin is okay, somewhat disappointing. Anyways, I would not be too excited about this stock in my view. So it's not a stock that I'm going to cover. And then moving on to Twilio. So Twilio is going to be the last stock, and then I'll briefly say why I didn't cover Tesla, because everybody else covers Tesla. That's essentially the reason why I didn't put Tesla on there. But let's talk about Twilio. So Twilio is the 10th stock that Cathie Wood has in her ETF, right, in her ARKW ETF. So what is Twilio? It's a communications API for SMS, voice, email, chat, and WhatsApp communication between companies and their customers. And it enables a whole bunch of digital marketing, customer follow-ups, etc. Twilio, I would put, for Cathie Wood, I would put it in the dirt cheap category. It's a stock that has been cheap for a while now, trading at 2.2x times sales, so it's pretty cheap. But maybe there's a good reason for why it's cheap. Namely, it doesn't grow very fast, 16% predicted growth over the next 12 months. And the gross margin is also fairly disappointing, especially for a pure play software like Twilio with a gross margin of 48%. So I can understand betting a little bit more that gross margin than a pure software space like Twilio at 48%. And the last stock that I want to cover really quickly here that I forgot to tell you about, of course, because I cover it, I think about it too much, so it doesn't even come up in my mind to tell you about Tesla. So Tesla is her 7th position in the ETF. Tesla has been steadily going down as some other stocks have been going up. She's been selling a little bit of Tesla too. So Tesla, I covered a little bit in the beginning, which is why I'm not telling you too much about Tesla. I believe Cathie would invest in Tesla for the binary event, the binary events of self-driving and the binary events of robotaxi. In my view, owning Cathie Wood's ETF to get exposure to Tesla is kind of a wrong way to do it. I would much rather own Tesla on my own than own Tesla through her ETF. She used to have a much bigger position in Tesla. It used to be consistently close to 10% in all of her ETFs. Now her position is smaller in Tesla, probably because she sees better valuation, better opportunities in a lot of these overplays. I consider, honestly, Tesla to be a very great option on the future of energy, and energy is the biggest play in our economy. So if you're interested in Tesla, I'll put a link in the description to a full 1-hour video that I did on Tesla. It's too complex of a company to explain in just a few minutes. My conviction in Tesla is the stock in which I have the most conviction, and I think you will find that Tesla is way too covered online, so I don't need to spend too much time on Tesla. You probably get it, which is also why I put it last in this video. So anyways, this was not investment advice. This was just entertainment, no financial advice at all. I hope simply that you were entertained. I appreciate your likes. Thanks for liking. Thanks for subscribing, and have a wonderful day.